Welcome back. In this segment of Decrease Outbound Cash Flow, we're going to talk about evaluating your budget and return on investment for every dollar spent. So one of the things I would strongly encourage every business out there is to create a budget. If you don't know how, reach out to your bookkeeper or accountant. They can help you. But really, truly, what the budget does is it sets the expectations, it sets the targets, and then it allows us to evaluate our decisions. If we're going to go over budget, we need to have a reason for it. If we're going to be under budget, that's great. The other thing, and this ties into the budget, is for every dollar spent, we need to understand what is the return on that investment. So for example, if you're spending money on an employee, typically you're looking at, for every dollar of wages, you're looking to get at least a $3 or $4 return. So if you've got an employee that you're spending $50,000 a year on, and that employee is generating $50,000 of income, you've broken even. So that's not a good spend. That one employee should bring you at least 150, 200,000 in revenue, obviously depending on your budget. If you're doing a marketing spend, you want to look at the marketing, and for every dollar as a benchmark, for every dollar of marketing you spend, that dollar should bring back 10. So if you spend $100 on marketing, you should earn $1,000 back. So look at your budget lines and don't get too hung up on the actual dollars. Focus on what is the return on investment. And my little advice to you is make decisions based on return on investment. The higher the return on investment, the better for the business. The faster you get that return on investment, the better for the business, generally. But think about both balancing long-term and short-term. And a good compromise is if something generates a reasonable return on investment in a reasonable time period, that's generally a good expense or spend.